6:15, time now for business news. And in for Mike Apple this morning once again is Kris McCusker. Good morning, Kris.
Hello, Tammie. How are you?
I'm good. I'm good. You made it through the fog and you made it to work. Good stuff.
Yeah, that was kind of weird this morning. It was hard to see.
Yeah, like a scary movie out there.
Yeah.
We have real estate that we're going to start off with this morning, and it looks like in terms of sales, they've gone down once again in October.
Yeah, so in October, Tammie, in Toronto and the GTA, half the number of transactions that we saw this time last year, and then new listings dropping to a level we have not seen in more than a decade. So this data today coming from the Toronto Regional Real Estate Board, and the board attributing much of the sales decline to a lack of inventory, which brokers have said is combining with higher interest rates and inflation to keep buyers out of the market. Simply put, sellers are holding off on listing properties because they fear they won't make as much as they would have 10 or 12 months ago when the market was a little hotter. New listings down 11.5% year over year. We haven't seen that since October of 2010. Now, average prices fell the most in the detached category, a drop here of 11% to 1.3 million. Interestingly, condo prices moving higher, up by almost 2%. So evidence now, let's say, that those interest rate hikes are working through the system.
At least through the real estate portion of it, for sure. Okay, so we're watching that. We also, as you predicted yesterday, of course, the U.S. interest rate has gone up once again. And is Canada watching?
I think so. And what's interesting is that we did see this 75 basis point interest rate increase in the U.S. yesterday, and that part of it was expected. But really, it was what was coming next that investors were listening for. Initially, it seemed the statement was a little dovish. But then when the Fed chair started talking to reporters, the tone changed, and it sounds like there are more interest rate hikes coming, likely smaller hikes to come in the U.S., but still more hikes coming. The U.S. central bank, like other central banks, working to cool inflation. The Bank of England is very likely to hike interest rates today, and it could be the biggest hike in decades. The Bank of Canada did hike interest rates last week, and we did hear from the Bank of Canada that, yes, there are more hikes coming in the future from the Bank of Canada, but that we're getting closer to the end of the cycle. And the Fed chair said a similar thing yesterday. Now, maybe one bright spot in this, Tammie, we are seeing oil pull back from a 3-week high this morning. Okay, it's only a 3-week high, but still a pullback in oil prices. We had heard that China was looking at rolling back its COVID zero policy. That's now been discounted. So that, along with these higher interest rates, is working out to lower oil prices, and that could cycle through at some point to lower gas prices. Fingers crossed.
That's it. So lower gas prices, and then, of course, we have a lower real estate pricing as well. So hopefully we get to the food pricing, and then we're all good. We're out of time, Kris, but just quickly, there is something, of course, about employee burnout and workers and employers concerned about this.
Yeah, so employers worried about employee burnout. They're also worried about their employees' financial stress with those higher interest rates. This is according to a survey from the Healthcare of Ontario Pension Plan, which shows that more than 4 in 5 employers are worried about the competitive labor market. Almost 2/3 worried about employee productivity, and employees, let's face it, have a lot on their minds. The survey also shows that almost 1 in 5 employers are introducing or improving retirement benefits this year, which may help with employee retention and morale. I guess time will tell on that.
All right, Kris, thank you so much this morning.
Okay.
We'll see you tomorrow.
Yes, happy Friday, Junior.
Happy Friday, Junior. Let's go. All right, thanks very much, Kris.